Today, I am going to talk about the basics of identifying a good mutual fund to invest in. After watching this video, you will be able to select mutual funds on your own by doing proper research, which will give you excellent returns over the long run. At the end of the video, I shall give you a few bonus tips which will help you in earning a few extra points from selected mutual funds. Firstly, let's go through what you shall learn in today's video session. What is mutual funds and how does it operate? Then I shall explain to you the common terms associated with mutual funds that you must be aware of before investing. Then I shall explain to you the advantages or why should we invest in mutual funds. Then I shall explain to you how to reduce risk in mutual funds. Then the different types of mutual funds will be explained by me. Then I shall go into how to do research to find a good mutual fund to invest in. Then I shall explain to you the procedure or legal formalities before investing in mutual funds. I shall also explain to you how much tax you will have to pay for any profits that you earn from mutual funds in India. Also, viewers are requested to stay towards the end of this video because I shall give you a few bonus tips by which you can increase the return of your mutual funds by a few percentage points. Mutual fund is a pool of money collected from a large number of investors and invest the same in equities, bonds, exchange traded funds, money market instruments, etc. The gains generated from this collective investment is distributed proportionally after deducting applicable expenses and levies. A professional fund manager is there who invests the money collected in mutual funds, and he generally invests this money in line with the scheme's stated objectives, which is mentioned in the scheme information document carefully. Now, I shall explain to you some common terms associated with mutual funds. Net asset value. When we buy mutual funds, we pay the price of net asset value to purchase one unit. Net asset value is like the share price of a company. For example, if we have to buy the shares of Reliance, and if Reliance share is currently trading at rupees 2000 per share in the stock market, then to buy one unit of Reliance or one share of Reliance, we have to pay rupees 2000. Likewise, if a mutual fund's NAV is 50 rupees, then we have to pay rupees 50 to purchase one unit of that mutual fund from the markets. The NAV of a mutual fund fluctuates daily and its value is released daily by the fund house. The formula for calculating NAV is asset minus liability divided by total shares. Here, assets mean value of all assets under the scheme like shares, bonds, money market instruments, cash, etc. And liabilities means wages for employees, utility bill, management fees, marketing cost, distribution cost, and other fees associated with the mutual funds operation. This asset value generally fluctuates daily. Asset under management. Asset under management is the total market value of all assets such as stocks, bonds, money market instruments, and other securities that a mutual fund manages on behalf of its clients. As the value of these assets constantly changes due to daily market fluctuations, so the value of the asset under management also changes on a daily basis. The higher the AUM, the more revenue an AMC can generate from its funds. AUM or asset under management is an important metric for mutual funds as it reflects the size of the fund and can be used as a measure of the fund's success in attracting and retaining investors. A fund with a larger asset under management may find it more difficult to achieve high returns, as it may be more challenging to find investment opportunities that can generate significant gains without disrupting the market. On the other hand, a smaller fund may be more flexible to take advantage of unique investment opportunities and can generate higher returns. As such, investors must strike a balance, and they must invest in a fund which has an asset under management at a reasonable level, like around more than 5,000 crores, but it should not be more than 20,000 crores. Now let us understand the concept of expense ratio. Expense ratio are the annual maintenance charges levied by mutual funds to finance its expenses. It includes operating cost, management fees paid to fund managers, advertising costs, distribution expenses, etc. Expense ratios are usually deducted from total revenue generated by a mutual fund before disbursing returns to investors. Since expense ratios levy a burden on annual returns earned, an investor should carefully analyze the same before choosing a mutual fund. So ideally, an investor should invest in a mutual fund with a lower expense ratio. NFO or new fund offer refers to the introduction of a new mutual fund scheme into the market by a mutual fund company. NFOs have a defined subscription period during which investors can subscribe to the new scheme by purchasing its units. Before considering investing in an NFO, an investor should carefully evaluate the scheme's investment opportunities, risk factors, track record of the AMC, or potential fit with their investment goals. Open-ended mutual fund. An open-ended mutual fund is open for buying and selling at any point of time. There is no maturity period in open-ended funds, which means that we can buy and sell at any point of time at the prevailing NAVs. In such type of funds, we can make lump sum investments or investments in periodic intervals through SIPs. Close-ended mutual funds are mutual fund schemes which have a defined maturity period. Units of a close-ended scheme are locked in till maturity. We can invest in close-ended schemes only during the new fund offer period, and we cannot make any investments after the NFO period is over. As such, these mutual fund schemes have very low liquidity. Exit load refers to a fee charged by mutual funds when investors redeem their units before a specified time period. It is levied to discourage premature withdrawals and protect long-term investors. The rate is generally around 1% if redeemed within the first 12 months. However, the rate may differ for different mutual funds. Passively managed mutual fund. A passively managed mutual fund follows the benchmark market index and replicates the portfolio of stocks in the benchmark index to mirror its performance. These funds may also be known as exchange traded funds, and they track a specific market index. Generally, mutual funds under this category have a lower expense ratio. An asset management company is an investment firm or a company that pulls money from clients and invests in different securities on their clients' behalf, aiming to generate returns for its investors while charging a fee for its services. Every asset management company has a number of mutual funds under it for the benefit of different categories of investors. There are different asset management companies in India like HDFC, ICICI, UTI, SBI, etc. An investor should carefully look into the track record of an asset management company. Now I shall explain to you how to reduce risk in mutual funds. First of all, it's very important to invest through SIPs. SIPs means systematic investment plan, that is investment in periodic intervals of time. Rather than investing by lump sum, ideally we should invest through systematic investment plans so that we can ride out the market volatility and have a safer investment. Second point is we need to invest in uncorrelated assets. Uncorrelated assets means those assets whose returns are inversely proportional to each other. For example, gold and silver's return is inversely proportional to the stock market. If you have noticed, during the 2020 COVID crash, when Nifty came down by many thousands of points, then gold's value was increasing. As such, commodities like gold and silver should be included in an ideal portfolio. Third point is we need to create an emergency fund of around 6 months of our monthly expenses before investing in mutual funds. Fourth point is diversify portfolio according to goals. Long-term goals and goals which are in luxury category can be achieved by investing in equity mutual funds. Goals which cannot be compromised, like children's education, children's marriage, retirement, can be achieved by investing in liquid funds. Ideally, goals which are of very long term, like goals which will happen in the next 10 years, we can achieve those by investing in equity mutual funds. But goals which are of very short term, those can be achieved by investing in liquid funds. Advantages of investing in mutual funds. First point is diversification. Mutual fund invest not only in equity or shares, but there are also certain mutual funds which invest in debt or in money market instruments or in commodities like gold and silver. So to properly diversify a portfolio, we need to invest in different kinds of mutual funds and not only in equity mutual funds. Second point is professional management. A mutual fund is managed by a professional fund manager who has a experience in managing a mutual fund. Third point is liquidity. A mutual fund can be bought and sold openly at any point of time in the case of open-ended mutual funds. So the mutual fund investments are very liquid. Fourth point is low minimum investment. We can start a systematic investment plan or SIP in mutual fund with as low as rupees 500. So their minimum investment requirement is very low in mutual funds. Fifth point is tax benefits. Equity linked savings schemes are eligible for tax exemption up to rupees 1,50,000 from annual taxable income under Section 80C of Income Tax Act. But this ELSS scheme has a mandatory lock-in period of 3 years. ELSS means equity linked savings schemes, and this is a type of mutual funds. Now I shall explain to you the different type of mutual funds that you can invest. First one is equity funds. In equity funds, at least 65% of the scheme's assets are invested in equity and equity related instruments. Equity funds can be further subdivided into large cap, mid cap, small cap and multi cap funds. Second one is debt funds. Debt funds invest in fixed income securities like corporate bonds, government bonds, money market instruments, etc. Debt funds are less volatile and hence less risky than equity funds. If we have been traditionally investing in fixed income products like bank deposits and looking for steady returns with low volatility, then debt funds are the way to go. Third one is hybrid funds. Hybrid funds are also known as balance funds. This consists of equity and debt components. Equity component is generally higher in the portfolio, suitable for investors who are looking for capital appreciation and low risk. Fourth one is liquid funds. Liquid funds invest in fixed income instruments like commercial paper, government securities, treasury bills, etc. with a maturity period of 91 days. Main objective of liquid fund is to provide capital protection and liquidity to investors. Investors who are investing with a short-term goal in mind, or if they require the funds within a short period of time, then ideally they can invest in liquid funds. Fifth one is tax saving funds or ELSS, equity linked saving schemes. Equity linked saving schemes have a minimum of 80% of total investable corpus in equity and equity related instruments. They are also known as tax saving schemes as they provide tax exemption up to Rs 1,50,000 from our annual taxable income. These funds have a mandatory lock-in period of 3 years, before which we cannot sell our investments. Now I shall explain to you different points by which you can find out a good mutual fund to invest in. First one is last 5 years returns. We should select only such mutual funds which has given consistent returns over the last 5 years. We should check whether the returns given by the mutual fund is more than the category average. We should also check whether the mutual fund has given returns during different market cycles. Second point is minimum age. The minimum age of the mutual fund should be of 5 years. The more the better. If the mutual fund has an age or existence of less than 5 years, then we should conveniently ignore such mutual funds. Third point is expense ratio. The expense ratio of the mutual fund should ideally be around 1.5% or lower. At least the expense ratio should be below the category average. We should compare the expense ratio of the mutual fund with different funds of the same category. For example, if you are looking at the expense ratio of a large cap mutual fund, then we should compare it with the expense ratio of other large cap mutual funds, and this rate ratio should be below 1.5%. Fourth point is fund house. We should select mutual funds of only reputed fund houses, where equity, debt, hybrid funds and various other schemes should be available under the same fund house. The fund house should be in the mutual fund business for a very long time. Most of the funds under the fund house should give high returns. Another point that we should look into while selecting mutual funds is turnover ratio. A lower turnover ratio is better. A high turnover ratio indicates higher churn in portfolio, which leads to higher brokerage and taxes. So ideally, we should select mutual funds with a lower turnover ratio compared to competitors in the same category. Another point is AUM, asset under management. Generally, mutual fund with a lower asset under management is better, but it should not be lower than 4,000 or 5,000 crores, and very high AUM is not good. Like if the AUM is above 12,000 crores, then the mutual fund has very large number of assets, so it shall face some difficulty in selecting new investments. So we should prefer mutual funds with lower AUM of below 12,000 crores, but it should not be lower than 4,000 or 5,000 crores. Another point we should check is mutual funds managers track record or the fund manager's track record. Longer track record should be there of the fund manager. A track record of around 5 years or more should be better. We should also check the fund manager's previous employee experience in the mutual fund industry and how he has performed over the last 5 years or 10 years. Now I shall explain to you the various methods by which an investor can start investing in mutual funds. Firstly, an investor can invest in mutual funds through a mutual fund distributor. An investor can approach a MFI registered mutual fund distributor for financial advice and mutual fund transactions. MFI means Association of Mutual Funds in India. MFI is the nodal association of mutual funds in India which provides information and insights related to the mutual fund industry. So, an investor can approach distributors who are registered under MFI and invest through them. They charge a commission for their services, and the expense ratio of such mutual funds are generally high. An investor can also directly invest with an asset management company. Investing directly with an asset management company or AMC via office visits or online portals. For new investors, submitting KYC documents is necessary. Direct plans with lower expense ratios are suitable for experienced investors with a grasp for risks and market knowledge, offering higher returns. So, if an investor chooses to invest directly with an AMC in direct plan of the mutual fund, then the cost of that mutual fund will be lower in respect of the expense ratio. An investor can also invest through a stockbroker. An investor can open an account with stockbrokers like Zerodha, Grow, etc. and open a Demat account there by which he can start investing in mutual funds. An investor can also open a Demat account in a bank. He can explore wealth management services offered by the banks for mutual fund investments. Being distributors, banks typically facilitate regular plans through their branches or online platforms. Out of all these sources, by investing directly with the asset management company, an investor can generate a little high returns of around 1% or 1.5% by saving on a commission charged by distributors or by having a lower expense ratio. Let us discuss the taxation structure of mutual funds. For equity mutual funds, gain from the sale of mutual funds held for less than 12 months are classified as short-term capital gains. These are taxed at the rate of 20%. On the other hand, when equity mutual funds are held for more than 12 months, they are classified as long-term capital gains if there are any profits. For such gains exceeding rupees 1,25,000, taxation of 12.5% applies. Hello, if you like my videos and if you want me to make more such videos on different topics of investment like share market, cryptocurrencies, golds, bonds and any other type of investments, then please subscribe and like my channel. I request you to kindly support me so that I can bring out more great content on this channel. Now, as I have promised, in the content section of this video, I will explain to you a few points by which you can increase the return of your mutual funds by a few percentage points if you follow all these points correctly. But you need to note that the earlier points which I have highlighted for selecting a good mutual fund, like last 5-year returns, expense ratio, fund house turnover ratio, asset under management, etc., should be followed strictly while selecting mutual funds. And the points which I am going to say now are also important to increase the return of mutual funds by a few percentage points. So the first point is direct plan for mutual funds. So ideally, we should invest directly by approaching the fund house or the asset management company, either by visiting their office, branch office, or we can invest online by submitting KYC documents. Direct plan offers a little higher returns than regular plans. Every mutual fund has regular plan and direct plan. In regular plan, there are intermediaries in between, so you have to pay them commission and other fees, and expense ratio is also higher while investing in regular plans. But for direct plans, we can directly approach the asset management company and invest through them, which will lead to lower cost, like lower expense ratio, and there will be no commission to intermediaries. So the absolute return at the end of the year will be a little higher for direct plans. Second point is step up investing. For every job holder or a person who is doing business, his income increases at the end of a year. For example, if you are in a job and you get a salary raise at the end of the year, then we can increase the amount of our SIPs, which will lead to higher returns over the long term. Second point is then we can also do cost averaging to increase the return of our mutual fund investment. Cost averaging means investing more amounts or larger amounts during market downturns. Like if you had invested larger amounts in SIPs during the 2020 market COVID crash, then you would have enjoyed much higher returns later. Likewise, during any market downturns, we should invest higher amounts in SIPs, which will lead to very large returns over the long run. Then another point is investing in small and mid-cap funds during market downturns. During market downturns like the 2020 COVID crash or like the 2008 Lehman Brothers crash, we should invest larger amounts in small and mid-cap mutual funds, which will give us larger returns. I hope you enjoyed today's video session. If you have any more queries regarding mutual funds, or if you have any doubts regarding what I tried to explain today regarding mutual funds, then you can ask your queries in the comment section. I shall try to reply to all. Thank you.